Imagine waking up one morning and realizing the entire financial world has quietly shifted beneath your feet. Not with a crash, not with a war, but with code. Right now, as you watch this, trillions of dollars are moving through systems that no single government controls. Currencies are being reinvented, banks are being bypassed, and a new kind of wealth is being built by people who understood something early, something most people still do not fully grasp. We are not talking about a get-rich-quick scheme. We are not talking about meme coins or overnight millionaires. We are talking about something far larger and far more consequential. The world is entering a new financial era. And before 2027, the decisions made today by governments, corporations, and individuals like you will determine who thrives and who is left behind. In the next 15 minutes, we are going to walk through the most critical crypto trends reshaping the world. No hype, no noise, just the patterns, the facts, and the forces that are quietly building the financial future. Stay until the end. What you learn here could change how you see money forever. To understand where crypto is going, we need to understand where it has been. In 2009, an anonymous developer, or group of developers, released Bitcoin. It was a quiet moment. Almost no one noticed. The technology was described in a 9-page paper, and its early adopters were mostly programmers curious about a strange idea: digital money without a central authority. By 2017, the world started paying attention. Bitcoin briefly crossed $20,000. Headlines exploded. People quit their jobs. Then the market crashed and most of the world wrote it off as a fad. They were wrong. What the critics missed was that the technology underneath, the blockchain, was evolving at extraordinary speed. Thousands of developers were building on it. Entire new financial systems were being coded into existence. And the next wave was already forming. By 2021, Bitcoin reached $69,000. Ethereum made it possible to run entire applications on a decentralized network. Companies like Tesla and MicroStrategy started holding crypto on their balance sheets. El Salvador made Bitcoin legal tender. And countries around the world began drafting crypto laws for the first time. Now, as we approach 2027, the landscape is shifting again, but this time, the changes are deeper, more structural, and more permanent than anything we have seen before. Here are the trends you absolutely must know. For years, Bitcoin was considered the territory of tech enthusiasts and risk-takers. Wall Street largely stayed away. Traditional finance looked at crypto the way an older generation looks at something new and unfamiliar, with suspicion. That era is over. In January 2024, the United States Securities and Exchange Commission approved the first spot Bitcoin exchange-traded funds, or ETFs, from major institutions including BlackRock, the largest asset manager in the world. Within weeks, billions of dollars flooded in. Fidelity, Invesco, and others followed. What this means is profound. For the first time, ordinary investors, people with standard brokerage accounts, retirement funds, pension plans, could gain exposure to Bitcoin without ever holding a crypto wallet. The barriers came down. By the end of 2024, spot Bitcoin ETFs had attracted tens of billions in inflows. Ethereum ETFs followed. And global institutional interest in crypto assets moved from experimental to mainstream. But this is only the beginning. Major banks are now building crypto custody services. Hedge funds are allocating portions of their portfolios to digital assets. Sovereign wealth funds, government-managed investment pools, are beginning to explore crypto exposure. Before 2027, analysts project that institutional holdings of Bitcoin alone could exceed $1 trillion. The implication is simple: crypto is no longer on the fringe of global finance. It is becoming part of the foundation. There is a mechanism built into Bitcoin that most people have never heard of, but that has proven to be one of the most powerful forces in all of finance. It is called the halving. Every approximately 4 years, the amount of new Bitcoin that miners receive as a reward for processing transactions is cut in half. This is programmed into Bitcoin's code. It cannot be changed. It cannot be overridden. It is mathematical law. In April 2024, the fourth Bitcoin halving occurred. The reward dropped from 6.25 Bitcoin per block to 3.125. This means the rate at which new Bitcoin enters circulation was cut in half overnight. Now, consider basic economics. When the supply of something decreases and demand stays the same, or increases, prices tend to rise. History has supported this pattern. After the 2012 halving, Bitcoin's price rose over 8,000% in the following year. After the 2016 halving, it rose nearly 3,000%. After the 2020 halving, it rose over 700% before reaching its all-time high. Each cycle, the magnitude of the price explosion may decrease as the market matures, but the direction has remained consistent. With the 2024 halving now in the past and institutional demand rising through ETFs, the supply shock is compounded. There are more buyers competing for a shrinking new supply. The next halving is projected around 2028. Between now and then, the market will feel the effects of this structural scarcity. Understanding the halving is not speculation. It is understanding the architecture of the asset itself. Perhaps no trend will shape crypto more profoundly before 2027 than regulation. For over a decade, crypto operated in a legal gray zone. Governments were uncertain how to classify it. Was it a currency? A commodity? A security? The answer varied from country to country, and even from agency to agency within the same government. That ambiguity is rapidly disappearing. In 2023, the European Union passed the Markets in Crypto Assets Regulation, known as MiCA, becoming the first major economy to establish a comprehensive legal framework for digital assets. It defines what crypto businesses can and cannot do. It requires licensing. It sets consumer protections. In the United States, Congress moved toward the first major crypto legislation in the country's history. The debate was contentious, but the direction was clear. Clarity was coming. Meanwhile, countries like the United Arab Emirates, Singapore, and Switzerland positioned themselves as crypto-friendly jurisdictions, attracting exchanges, funds, and blockchain companies looking for stable legal ground. And in a development many did not expect, China, which banned crypto trading years ago, began quietly exploring ways to reassert influence in the digital asset space through its own state-controlled digital currency. The global regulatory picture by 2027 will look dramatically different from today. For investors and builders in the space, this creates both risk and opportunity. The risk: stricter rules may restrict certain activities in certain markets. The opportunity: legal clarity attracts capital. When institutions know the rules of the game, they play more aggressively. Regulation is not the death of crypto. For many, it is the beginning of its true growth. Imagine a bank that never sleeps, has no employees, charges almost no fees, cannot discriminate against you based on where you live, and runs entirely on code. That is decentralized finance, or DeFi. DeFi refers to a category of financial applications built on blockchain networks, primarily Ethereum, that replicate traditional financial services without any central institution. You can lend money and earn interest. You can borrow against your assets. You can trade currencies directly with other people. All of it governed by smart contracts, self-executing pieces of code that automatically enforce the terms of any agreement. In 2020, DeFi was a niche experiment. By 2021, it had attracted over $100 billion in assets. And while the market corrections of 2022 shook out many speculative projects, the core infrastructure became stronger and more refined. The DeFi protocols that survived are now processing billions of dollars in transactions every day. New innovations, like real-world asset tokenization, which brings traditional financial instruments like bonds and real estate onto the blockchain, are expanding what DeFi can do. Before 2027, the convergence of DeFi with traditional finance will accelerate. Major banks are exploring how to use DeFi protocols for settlement and liquidity. Governments are studying how smart contracts can be used in public financial systems. The promise of DeFi is not just efficiency. It is access. Over 1 billion people worldwide remain unbanked, without access to basic financial services. Decentralized finance has the potential to reach them in ways that traditional banking never could. That is not just a financial story. That is a human one. One of the least glamorous but most consequential trends in crypto is also one of the most misunderstood: stablecoins. Unlike Bitcoin or Ethereum, which can be highly volatile, stablecoins are designed to maintain a consistent value, usually pegged to a traditional currency like the US dollar. The most widely used stablecoins, including Tether and USD Coin, are each backed by dollar-equivalent reserves held in regulated financial institutions. Why does this matter? Because stablecoins solve one of crypto's biggest real-world problems: price volatility. A merchant cannot easily price goods in Bitcoin when its value might change 10% in a day. But they can accept a digital dollar that is always worth $1. Today, stablecoins are already powering global trade in ways most people never see. A freelancer in Argentina can receive payment in stablecoins and avoid her country's inflation. A company in Southeast Asia can send payments to suppliers in Europe without paying bank wire fees or waiting 3 business days. Before 2027, analysts expect stablecoins to become a central part of the global payments infrastructure. Visa and MasterCard are already integrating stablecoin settlement into their networks. PayPal launched its own stablecoin. And governments are watching closely. Some are concerned. The widespread use of dollar-backed stablecoins globally means the US dollar is effectively extending its reach digitally, sometimes into countries that would rather limit American financial influence. The geopolitics of stablecoins will be one of the defining financial debates of this decade. But for ordinary users, the implication is simpler: fast, cheap, borderless digital money is becoming a reality. While private stablecoins expand from below, governments are building their own digital currencies from above. They are called central bank digital currencies, or CBDCs. And they represent the most significant transformation of money by governments since the end of the gold standard. Over 100 countries are currently researching, piloting, or actively deploying CBDCs. China has the most advanced system. The digital yuan, called the eCNY, is already being used in millions of transactions daily across major Chinese cities. The European Central Bank is in the advanced pilot phase of a digital euro. The United States Federal Reserve has been studying a digital dollar, though political debates have slowed progress. CBDCs are not crypto in the traditional sense. They are not decentralized. They are not permissionless. They are government-controlled digital versions of national currencies. But their interaction with the broader crypto ecosystem will be significant. Some experts believe CBDCs will drive wider adoption of digital wallets and blockchain-based transactions, normalizing the infrastructure that crypto also relies on. Others are concerned about what CBDCs might enable. A programmable digital currency issued by a government can, in theory, be designed with restrictions, expiration dates, spending limits, or automatic compliance mechanisms that would be impossible with physical cash. The debate around CBDCs raises deep questions about financial privacy, freedom, and the proper role of governments in monetary systems. Before 2027, at least several major economies will have launched functional CBDCs. How citizens respond, and whether they accept or resist them, will shape the political economy of money for generations. Two of the most transformative technologies of our time are beginning to merge, and the implications are extraordinary. Artificial intelligence and blockchain are not obvious partners. One is about computing patterns and making decisions. The other is about recording and verifying information in a tamper-proof way. But together, they address each other's weaknesses. AI systems are powerful, but they have a transparency problem. When an AI makes a decision, in a financial system, a healthcare application, or a legal process, it can be difficult to audit how that decision was made. Blockchain can provide an immutable record of an AI's inputs, logic, and outputs. This creates accountability. Conversely, blockchain systems generate enormous amounts of data: transaction records, contract terms, network activity. AI can analyze this data at scales impossible for humans, identifying patterns, detecting fraud, optimizing network performance, and predicting market behavior. Several projects are already building decentralized AI networks, systems where the computing power needed for AI is distributed across thousands of machines, rather than concentrated in the servers of a single company. This has significant implications. As concerns about AI monopolization grow, with a handful of companies controlling the most powerful models, decentralized AI networks offer an alternative architecture, one where the infrastructure is owned collectively and access cannot be gatekept. Before 2027, the intersection of AI and blockchain will be one of the fastest growing and most funded areas in the technology sector. The projects that successfully marry these two technologies could represent some of the most transformative companies of the decade. What if you could own a fraction of the Eiffel Tower, or a share of a Van Gogh painting, or a piece of farmland in Iowa, without being a multimillionaire? Tokenization makes this possible. And it may be the most sweeping transformation that blockchain technology brings to the physical world. Tokenization refers to the process of representing ownership of a real-world asset as a digital token on a blockchain. Once tokenized, assets can be divided into fractions, transferred instantly, traded globally, and verified without paperwork. Real estate, historically one of the least liquid asset classes, is being tokenized. Properties in New York, London, and Dubai are being broken into thousands of digital tokens, each representing fractional ownership. Anyone with an internet connection can invest. Government bonds and corporate debt are being issued on-chain by major financial institutions. BlackRock, JP Morgan, and Goldman Sachs have all launched tokenized fund products. The global tokenization market is projected to reach tens of trillions of dollars by 2030. Before 2027, the infrastructure for trading, holding, and regulating tokenized assets will largely be in place. The implications for wealth equality are profound. Throughout history, the most valuable assets, prime real estate, private equity, fine art, have been accessible only to the wealthy. Tokenization is beginning to break those barriers. It will not happen overnight. Regulation, liquidity, and legal frameworks still need to mature. But the direction is clear. The ownership of the world's most valuable assets is becoming programmable and accessible. We have covered a lot of ground. Let us bring it together. The world is not waiting for crypto to become relevant. It already is. From the boardrooms of BlackRock to the informal markets of sub-Saharan Africa. From the legislative halls of Brussels to the code repositories of developers working in anonymity around the world. 8 trends are converging before 2027. Institutional adoption is bringing trillions in new capital. The Bitcoin halving is creating structural scarcity. Global regulation is bringing clarity. Decentralized finance is rebuilding the architecture of banking. Stablecoins are transforming how money moves across borders. Central bank digital currencies are reshaping monetary sovereignty. Artificial intelligence is merging with blockchain to create new forms of transparent automation. And tokenization is making the world's most valuable assets programmable and accessible. Each of these trends, taken alone, is significant. Together, they represent something historic. The first major restructuring of the global financial system in nearly a century. You do not need to be an expert to navigate this. You do not need to be wealthy, but you do need to be informed. The people who understood the internet in 1995, not as a curiosity, but as infrastructure, had a different relationship to the world that followed. The same is true here. This is the window before the mainstream catches up, before the language becomes common, before the decisions become obvious in hindsight. What you do with this knowledge is yours to decide. If this video gave you something worth thinking about, share it with someone who needs to hear it. Leave a comment telling us which trends surprised you most. And if you want to stay ahead of where the financial world is going, subscribe. There is much more ahead. The future of money is being written right now. Make sure you are reading it.